The Federal Reserve is meeting next week. They're having their 2-day meeting. It is widely expected they're going to raise interest rates 0.25%. But you know who's not going to be raising interest rates anytime soon is the Bank of England. You had flagged a story about how the Bank of England, the low oil prices and slower wage growth leads to the Bank of England coming out and saying the U.S. can do what it wants. We're not going to automatically bump up rates just because they are.
Yeah, these lower for longer sort of interest rate paradigm that we've been in has been, gosh, I guess it's like 6 years in the making now. And I think really it is just one more piece of evidence that globally we have been going through a pretty dramatic deflationary scenario that looks a lot like what Japan's 20 to 25 year deflation has looked like to date. And I'm not a macro investor. I'm not buying buying or selling treasury bonds or futures or whatever. But the implications.
Come on, that's really sexy.
But I think the implications for stock market investors, for business investors, is that it's just sort of one more promotion of the idea that it's really the highest quality companies in the world that have the most pricing power that are the sort of quote-unquote safest places to play. As a little bit of a contrarian investor personally, that's been very damaging to my portfolio over the last year because I've placed a lot of bets looking for that really disparate market where the quality players have big increasing PE ratios and the energy and commodity type stocks have gotten really decimated. Eventually that will turn around, but as long as this deflationary sort of scenario that the central banks are indicating is here and will continue to be here, as long as it sticks around, it's those highest quality Nikes and Costco's and Google's and Visas that are going to be continue to have the kind of multiple expansion that they've seen, and it's been really, really dramatic. I mean, a lot of these stocks look very, very expensive versus their historic average PE ratios.
When you start thinking about the start of 2016, is there an industry that you find yourself gravitating towards? I know that energy has not been kind to you, or frankly to anyone really, over the last 12 to 18 months. Are you still looking at the energy industry, or are there other places you're looking to in 2016?
No, I am. The energy and basic materials industries for a contrarian investor still look very, very attractive. There's a company that we're looking at in Stock Advisor right now, which we'll be publishing next week, so I won't talk about the specifics of the company right now. But it plays in that space and is a high quality player, but in a very dramatically beaten down industry, and it's something that we have we're considering very highly coming up. We have traditionally really focused in on these highest quality players, and there was a time where they just didn't get the credit they were due, and so we've been very successful owning and continuing to recommend those companies like Nike and Google and Facebook and the rest of it. But you won't see too many of those companies on the top of our Best Buys Now list today. You've got Nike has gone from an average PE of 20 to 33 times earnings today. Costco from 24 to 31. Facebook was, a 75 PE player, obviously, a very strong grower, but it's up to 105 times earnings today. Visa going from 23 to 30 times earnings. So these are not, this is the market saying that pricing power wins in a no growth global market, and the market is willing to pay up for them. It makes it very difficult to have dramatic outperformance, I think, in those companies in the ensuing 5 years, unless we really are in this sort of dramatic deflationary scenario, and it lasts a heck of a lot longer than I suspect it will.
I'm going to ask you to look into your crystal ball with respect to the energy industry. My expectation...
Pork bellies.
Pork bellies. I think something very exciting is going to happen in pork bellies. At the beginning of this year, I really expected to see a lot of M&A activity in the energy industry. And we've had some of that, but not really to the degree that I think a lot of other people were expecting. And I'm wondering if it's being pushed out another year, because we were talking about it this morning, that you go back in time 1 year, plenty of people were saying, oil's going to bounce back.
That's right.
And that's no longer the case. And I'm wondering if now some of these companies, smaller players in oil and gas that have made it through 2015 are now looking at 2016 and thinking, gosh, if things don't turn around fast, we're going to have to look for a dance partner?
So I think there's two things going on here that explain why there's been fairly low M&A activity in that space. First of all is that there has not really been a meeting of the minds between potential buyers and potential sellers, and a lot of that is the dynamic that you just described, where oil producers in particular are saying, well, we're basing our expectations and what we see this company worth on a $60 oil price deck or a $50 oil price deck, and buyers are looking at this and saying, well, that doesn't make a whole lot of sense to us. That doesn't suggest that the price you're offering the company at is a bargain, and so we're less interested in buying it. And secondly, and maybe even more importantly, is that as this sort of tremendous volatility in the oil markets is taking place, there's actually it's becoming more and more difficult to obtain financing to fund new growth projects and to fund M&A. And so you've seen that with investment banks that specialize in energy businesses have had a dramatic slowdown. Because of that, the financing is very, very difficult. And frankly, in circumstances like this, when there's a huge washout in oil prices, potential buyers are less likely to say, well, I'm going to go and buy the equity of your company and buy it out from shareholders, and instead say, well, things look bad enough that if we can just be patient, a lot of these smaller players are just going to go bankrupt, and we can buy the assets for pennies on the dollar rather than having to buy the equity and then carry this big debt loads that these companies have.